Hey, good afternoon, everybody. So we'll go ahead and get started. Here to talk about the one big beautiful bill and what it means to people who invest in real estate. We are ABG and Associates. Michael Crosafoglia is on the call, and he is my partner here. And there you see our little pictures. Most of you I have met personally, so you probably know about me already. Some of you have met Michael, but Michael's on the screen and he can say hello to you.
Yeah, afternoon, everybody. Nice to meet you guys virtually, anyways. Hopefully, we get to meet in person. I've been partnered with Ashley for about the past 2 years. I've been in real estate for about 6 years, built a portfolio up in the Northeast during that time. I'm from Pennsylvania originally, moved down to North Carolina here in Wilmington in 2023. And met up with Ashley at that point where we started taking the syndication in ABG Associates to the next level.
Yeah, well said. So that leads to this assets under management. Currently, our group has about 40 million assets under management. And, we got some big goals and we would like to grow that to 200 million in the next 3 years. And so that's a big jump, but we're confident that we can do it. We enjoy this business very much. We have fun with it. We are all in the middle of it, right, Michael? This week we're in the middle of really the heart of this business, and we love it. It's a challenge every day. It's a good problem solving exercises. We get to meet and do business with lots of great folks like y'all. We want to do more of it, and that's why we're here. So we'll get into a little bit of this. A lot of these we'll probably breeze through a little bit and heading towards one big plus in particular. And I have a degree in accounting from West Virginia University that I got 30 years ago or so. But I had to go back to summer school to retake cost accounting just to get a C average in my major. And I never had any desire to be a public accountant. So that's a disclaimer that I am not a CPA, neither is Michael. And you need to really consult, you need to really rely on your tax professionals for these types of things because there's so many variables. If you don't have a good tax professional, we certainly can recommend some. But point number two, the low income housing tax credit, that tax credit was increased. And so the gist of all these things, you'll start to see a trend is to put more money in the pockets of people like you so that you will invest in more real estate. So the government, they know that they can't do all things. And they know that they can't do all things well. So they try to incentivize people like us to do them. And I say us, meaning all of y'all, not just me and Michael. So the low income housing tax credit is one of those things. The government knows that we need more housing of all types, but especially low income housing. And so they incentivize developers to go out and develop new units of low income housing. So that's what that one does. Opportunity zones. If you don't know what they are, basically the governors of the states every 10 years get out a big map of their state and they highlight certain areas that they want to see some increased development in. And opportunity zones carry with them some tax benefits that if you hold it for 10 years or more, it's really a big bonus. You can basically get away with no capital gains tax at all. In certain instances, you can create businesses on the property that you buy and you have tax benefits even on the income of those businesses. You really need to find a tax professional that knows specifically about each of these things if you choose to get into those things. The SALT cap, that's state and local tax deduction. The gist of that, if you don't know, is if you pay property tax, for instance, to your local municipality, that you get to deduct that so you don't have to basically be double dipped or taxed on the income you've already paid out in the tax. That one, the SALT tax, by the way, and several of these do, they have like phase out provisions. Like SALT tax, if you make, I think it's starting at $500,000 or something like that a year, then they start to pull back on those deductions. They won't let you have the entire thing. But they raised it from 10,000 to 40,000. You guys may all make too much money and not qualify from that, but you need to ask a tax professional. The one big beautiful bill, basically, Donald Trump is a real estate guy. And so he's going to make sure that real estate is protected. They know how important it is to our nation. And so a lot of the breaks that were put into place in 2017 with the Tax Cuts and Jobs Act are now made permanent. And I use quotes because everybody knows that with the government, a new regime comes in and they may make something unpermanent. But for now, it's permanent. Okay. Let's see. Permanently preserves 20% QBI. That's qualified business income. Again, consult with your CPA, but the gist of that one is that if you make money or make investments using certain entities, that some or all of that income, not all of it, but some of it could be deductible. And so that's something that as you decide whether or not you want to be involved in investing in real estate, you should ask your tax professional, okay, how should I structure myself to best take advantage of these tax laws? Maybe it's not investing as an individual. Maybe it's that you create an LLC and you invest with that. But again, that's each of you are going to have unique situations. And so you need to really, this is basically to give you enough to ask the questions. You need to ask these questions. Now, the 100% bonus depreciation, that's the big one for us. And so we'll talk mostly about that today. Before we dive into that, anybody have any questions on the stuff we've kind of breezed through so far? The mortgage interest comes into play when people buy things or buy a house with less than a 20% down payment
Insurance.
most of the time.
Insurance.
Yeah. And so they at least get to deduct what they've paid in that insurance. So keeping
Got
that
it.
cash in their pocket.
Going to apply if you're in FHA loans, USDA, government sponsored loans. That's where and you're usually putting a smaller percentage down. So if you're putting 5, 10, 15% down, usually there's a mortgage insurance premium tacked on to your monthly payment that you're paying on top of your interest
Right.
and principal. So that's the portion that they're targeting with the bill.
All right. So let's talk about this bonus depreciation stuff. This is a big deal because these can be pretty big numbers. So this example that we'll talk about, Bryn Mawr Village, this is a property that ABG and Associates purchased back in February of 2025. And we are literally right in the middle of going down this road. We've done this before with other properties, and I'm going to show you some real life numbers on a K1 here in a minute from another property. So, we buy this property, we use debt, so we borrow money to buy it, and we also have limited partners that invest in these deals. This one was an 80-20 split, so that the limited partners own 80% of it. And you can see here on that right side underneath the little map. And so when you invest in this example, $100,000, you get 1.3% ownership in the entity that owns the asset. So there's an LLC that owns the apartment complex, and your 100,000 gets you 1.3% ownership of that entity. If we estimate our net operating income, 1.5 million for 2025, that's the real number. That's our real estimate. And then you can come and we have a $5 million depreciation deduction that we plan to get, and I'll show you a little more detail. And so if you subtract those two, that's a paper loss of 3.5 million. And then you get your share of that 3.5 million that passes through to you as a passive loss. And let's make the assumption that you're in the 37% tax bracket. Well, the simple math says that translates to almost a $17,000 savings in taxes. So you see, and again, everybody's situation is different, but that shows you that those are real dollars to be saved. Now, what's interesting, I think also, is that look on the left side of the screen, you see that these returns that are projected, those don't even include that extra tax benefit. So there's an extra $17,000 tacked on to the benefit that you receive from this investment that's not even included in these returns. So technically those returns are a good bit higher than just what we've projected. The cost segregation of bonus depreciation, that little cutout is something that I'd like to stop sharing this screen and show you a different screen if I can. I'm going to pull up an actual report here.
Tying back to the One Big Beautiful Bill Act, 100% bonus depreciation is back, whereas previously, under the last administration, it was being phased out. So we were getting ready to see it phase down to about 40%, and now bonus depreciation is back at 100%. So the reason this is important for our asset is our asset went into service. That's what the IRS uses as their classification for this bonus depreciation. It went into service after, I think January 19th was the date of 2025. So since we bought this in February, on February 10th, it's technically after that date, and we get to benefit from this 100% depreciation, bonus depreciation in year one. So those were the numbers Ashley was just walking you through.
Yeah. Yeah, well said. So, in order to take advantage of these types of things, you have to satisfy some IRS requirements. So you have to get a cost segregation study. So basically, this ELB Consulting, who we've used before and done a great job for us, they actually send a person to the property, and then the person counts representative number of units and all of the components, and then they prepare these reports. And the reports, the gist of it is that they break down, say, okay, we have this many feet of wiring, we have this many light fixtures, we have this many square feet of carpet, we have this many cubic yards of concrete sidewalks. I mean, it's really like an in-depth study. But the reason they do that is because each of those things in real life has a different lifespan. Roof shingles, may they last 27 and a half years or whatever, but they say that certain other things, appliances, don't, for example. And I'll show you that as we go through this study. This is the little cutout that was in the slide, the tax benefits. And so we're saying that we're going to pass on to to the owners. I'm an owner, Michael's an owner, and the other LPs. There's going to be this cash value of tax benefits, and you get your share of that. So as we go down, and again, the point of all this, I think it's interesting to remember the point of all this. The point is that the government wants people like you and us to have more money in your pocket so that you will invest in more of these things, so that you will provide more of what the government needs you to provide. So in this case is housing. They need more housing. They need more people like us to do it. So they find ways to incentivize us. So basically reducing your tax so you got more money in your pocket now. And without getting into the math of it, the idea of all this is it's better to have a dollar today than to have a dollar 20 years from now. So they want you to have as much in your pocket right now so that you can do more with. And as a prudent investor, you're better off having the asset or the dollar in your pocket right now to do something with. All right. So you see
And
here that,
just a quick
yeah, go
point
ahead. Yeah, yeah.
for Ashley and myself. This is a critical tool in our toolbox as general partners. It's our responsibility, I would say, in all instances where it makes sense. And we're always consulting with our CPAs about where does it make sense to execute the cost segregation study. It's our responsibility to do this for our limited partners because the benefit's huge. So the fact that we're able to pass along in the example that we gave, if you're investing 100,000 and you're getting almost a $50,000 loss in year one, that's half of your initial investment, and that's icing on the cake that we're not even advertising in the returns. So
Mhm.
for Ashley and I think we take it as a personal point of pride that we're able to offer these kind of things to our LPs.
Yep. Yep. Well said. And selfishly, we enjoy the benefits
Well, and
also.
that too.
Yeah. So look here, straight line depreciation. Oh, by the way, jump back up. So we paid 21,250,000 for the apartment complex. You have to subtract out the land value. So this 4,250,000, you can't depreciate land. Land doesn't wear out. Land always is. Land stays. Land's permanent. So that leaves you with a $17 million depreciable cost basis. So that's the improvements. Now, if you were just to use straight line depreciation and you take that and divide it by 27 and a half years, which is what they allow for commercial property, then you have $618,000 a year. And that's what you can deduct, depreciate. That's what we would share with our investors. So we would still share some, but it wouldn't be as much. So with in this middle section with the kind of this orangish color, that's the conservative estimate. And Michael and I are both pretty conservative, so we like to stick to the conservatives. But if you break it down, you can see that, 27 and a half year property, 13 million of it is that. I mean, you've got over here, you've got a 5 year property, you've got $2 million worth. And so you can take those types of depreciations earlier and you benefit more. So jump down here to year one, the additional depreciation, and you get the straight line. And there's the big one, the bonus of 2 million to 2.2 million. And so you get a total of almost $3 million of depreciation with a net cash benefit of $1 million that we would pass on. Now, somehow, and you'll see even down here, the target of this engineering firm is to hit the midpoint between the conservative and the optimistic. And so their expectation is that we will be able to pass on a cash value first year of $1.4 million. So pretty huge. Our CPA firm, they're very experienced with, I mean, basically they specialize in nothing but real estate investors, and they love these things. This is one of their favorite tools. They don't recommend it if you're just going to flip something, but if you're going to hold something 5 years or more, this is definitely a tool you need to have. I think it's interesting that this little graphic in the report breaks down like what certain properties are. So you see in the blue one, 5 or 7 year property, and that includes like electrical things, specialty plumbing, decorative lighting, flooring, and wall coverings. So as you all know in your own house, floor coverings don't last 27 and a half years. Even if it's a hardwood floor that lasts for a long time, you still got to refinish it and do those types of things. So it loses value. And that's what the government's allowing you to take advantage of. Some 15-year property, curbing, parking, asphalt, concrete, site lighting, fences, signage, landscaping. Yeah, landscaping. You can even deduct like the bushes that you put in. So it's pretty awesome. Underground utilities and drainage. And then the physical building itself or the envelope is 27 and a half year. And that's what it would be straight line if you just did the straight line. In this case, we're accelerating that 5, 7, and 15-year property. So yeah, 27 and a half year property is roof, windows, doors, HVAC, bathrooms. Let's see, there was one other thing I wanted to show you on this report. Well, that's how much it cost us. Yeah, I think that's about it. I think that's about it I wanted to share with you on the report. All right, let me show you an example of a real life tax situation here. So now can you see, are you looking at the K1, 2024 K1, this tax document? So this is actually one that I received personally. So you can see here that ABG Invest, that's an LLC, by the way, that I created to invest. That's my personal share of investments in these properties. So I use that LLC. It's a single member LLC pass through entity, blah, 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 but that's the way I've chosen to do it. This North Davis LLC up here in part one, that's the entity that owns the asset. And this is for Davis Mills. This is a property that we bought in 2023, and it's in Gastonia, North Carolina. It's a much smaller property. It's only 37 units, but it works just the same. What I think is important for you to see is that on box number 2 here, the net rental real estate income or loss was a negative 51,688. So I'm showing the IRS that I lost $51,000 for my share of this investment. But if you look down here in number 19 under distributions, you see that I actually received a check in the mail, if you will, for totaling $13,000. So I received cash and that I get to put in my pocket. I get to spend on whatever I wanted to spend it on. But I showed the IRS that I lost $51,000. I mean, that is the power of this bonus depreciation stuff and cost segregation. It's truly like it's almost mind blowing. And sometimes I say, man, is this even legal? Like, you're allowed to do this? Let's say that we depreciate this asset and all of our owners and us, we take advantage of these tax savings, right? Well, let's say Clark and Joe form a group and they buy it from us. Well, guess what? Clark and Joe get to do this all over again, even if it's already been done, even if it's the same floor covering, the same roof. You don't have to put new stuff in to benefit from it. It's pretty amazing. It's really one of those things that is very special to real estate that you just can't get in other places. You don't get these benefits investing in stocks and things like that. This is a real estate thing. So net real estate loss, 51,000. And
Sorry, can
see,
I
I
stop
know.
for a second,
Oh, go ahead.
Ashley?
Yeah, Joe.
The fifth 51, does that become a tax loss carry forward that you offset against the future income or distributions starting with the
Correct.
15?
Correct. It does not go away. And so
Okay.
And
it carries
Joe, it's
forward.
But you eat through it year by year. Is that right?
depends on your personal situation. If you have other assets that qualify on the same schedule on your tax return, you can shelter that income in the same year. Your only asset that you're protecting that passive income, then it would be carried forward.
They talk about, I remember back to my accounting classes, they talk about buckets of income, right? Ordinary income is one bucket, passive income is another bucket. And you can only use passive loss against passive income or an ordinary
Right.
loss against ordinary income. So it just depends on your situation. Now, I will say, I know that Hoke is a real estate professional, and so are Michael and I. And that real estate professional, that's a as defined by the IRS term. Our income from our day job, if you will. So all of our income is ordinary income. So my $51,000 loss for me goes all into the same bucket. So if I made money or my team made money and I benefited from it as a commission income from my day job, then this offsets that. Now, if you were a doctor and you had your ordinary income and then you had your passive income, this would not offset your income from being a doctor. Maybe you have a spouse who is uh, has a real estate license and meets the IRS requirements for becoming a real estate professional, and in some cases, you can offset some of those incomes. That's why it's important to ask this question. There are ways to do this, and it's huge. I've had investors that, as you might imagine, a lot of the investors in these things are real estate professionals because that's who I work with and that's who I know. And when they get their K-1s, they get their taxes prepared, I get phone calls or texts, and they're just elated at the cash that they saved from their taxes. It's a big deal. All right, so let's stop that. Jump back over here to these slides. Yeah, I think that, and we can talk more. There's our contact information, and if you want to scan it. But that's really the end of the presentation as far as the tax benefits from the one big beautiful bill. Obviously, that bonus depreciation is a huge part of it. It's not the only part, but it is the number one biggest part of it for sure. So, Michael, what did I leave out?
No, I think you hit the major points. I just, what questions do you guys have for us in terms of, how can you take advantage of these types of benefits, or, what does it mean outside of real estate? What kind of questions do you guys have?
Can you guys remind me again how many units you guys had in Bryn Mawr? How many
There's a
units Bryn
hundred,
Mawr is?
yeah, 196 in Bryn Mawr.
And that one, and that was around 21 million or something like that is what you guys
Right.
Yep.
paid for
We,
it.
we
It was
purchased
about
it for
108,000 a unit, roughly 108,000 and change per unit.
Okay. What is the rest of your portfolio made up of? Is it another Bryn Mawr or is it a bunch of smaller ones?
It's the next largest so Bryn Mawr is the largest by a good bit. The previous one, the Gastonia deal, Davis Mills, was 37 units. And then I've got a 32 unit property in Lillington that Joel knows about. And I've owned that one since 2018. And by the way, this blows my mind, but I bought that one for roughly $32,000 a unit. And now and just to think that how prices have gone up, COVID really sent the world crazy a little bit, and real estate values were one of those things that jumped up, which now that I mention it, COVID was a scary time for lots of reasons. But one of the things that was scary is that we didn't know what was going to happen to all of our investments. We being the world's population, right? Well, what happened was that people protected where they live. They protected their shelter and the roof over their head. Uh, We had maybe one, and I really don't think it was legitimately COVID related, maybe one tenant that we had that left and owed us money. People were worried, well, they're not going to be able to pay their rent, and so it might be a bad investment. What really happened is multifamily was the darling of COVID. Everybody wanted in because people made sure that they had a place to live. So we felt that just solidified to me what I already knew, that it was a good investment. But having gone through maybe one of the worst case scenarios you can imagine, and multifamily investing came out on top. So that was pretty cool.
Yeah, and
Are
if
you
you look at our
guys
plan for growth, kind of going from that 40 million asset under management to 200 million, we're going about it through the acquisition of properties like Bryn Mawr. So we kind of are scaling up, but what we're underwriting today are those properties. It's not necessarily a unit count that we're targeting, but more so a value. So we're looking, at A class markets, B class, C class, but then the value per unit is going to jump when you look at a Charlotte or Raleigh versus a Jacksonville. And we're starting to underwrite properties, anywhere from 100 units up to 450 units. And what's interesting is that the methodology at the end of the day is the same. You're just looking at different, you're taking what we've learned and perfected over years and applying it to a bigger scale, but it's essentially the same formula for success. And a lot of it boils down to a conservative underwriting and making sure you can actually deliver on your promises. And if you can do those two things and you can make people money, typically you build that level of trust you need to succeed.
Mhm.
is Bryn Mawr, where would that class in A, B, or C?
So
Probably C.
yeah, Bryn Mawr's a working class housing uh, development. So that's a
Mhm.
C class, and it's one of those that the business plan was not a value add. So a lot of these investments, people will sell you on the value add component, where yeah, we're gonna go in, we're gonna make everything platinum grade and quartz countertops and new vinyl plank flooring, etc. The beauty of this property is we didn't have to do any of that. So we took over a performing asset. It was performing as is. We were able to make operational benefits around insurance, around payroll, around tenant retention that were immediate benefits on the net operating income, to the point where Ashley and I look at the value of this property probably too frequently. We rerun the numbers, and it's already up, roughly $5 million from when we bought it in February.
Yeah, just looking on Moody's at the unit costs for that sort of stuff is a lot more than 108,000 a
Oh
unit
goodness,
at the
yeah.
moment. So it was a great
Yeah, the
deal.
basis that we have in that is as close to bulletproof as you can get, I think, and that's a real key. A lot of the people that are, I don't know if they're in trouble yet, but we feel like it may be coming. They bought things based on what the pro forma was. Like, if you buy this thing and if you go in and do all this work and if you add all this value, then you can bump the rents by X amount. Oh, and by the way, go ahead and use short-term debt because I'm sure the interest rates will either be the same or come down. So all of that'll be fine. Well, what really happened was that rents did not continue to go up at the same rate they were, and interest rates definitely didn't come down. They doubled in some cases. And so Michael and I, in the boots on the ground right now, my phone is ringing off the hook, and we're getting emails multiple a day, more than in the past 2 years, of properties that are available. And in increasing cases, we literally are getting emails from the brokers saying, look, the owner basically just told me to tell everybody that they need an offer. They need out of this thing fast. And what it means is their short-term debt's coming up. They don't have the financial performance from the asset to refinance the debt, and their loan's going to get called, or they're going to have to reach out to all their investors and say, hey, we need you to send us another whatever, $100,000 each so that we can just give the bank some money so we can refinance it. That's a very bad situation to be in. And knock on wood, it doesn't happen to us, but we don't think it will because of that conservative underwriting that Michael talked about. If it's producing this today, then we will pay you this value, not what we think it'll be in 2 years. So far, that's been a good strategy.
Ashley, is there a on Bryn Mawr, for example, is there a sort of an assumed time frame for that investment? Is there anything about the bonus depreciation that means the best part of owning that is going to be the first 5 years and then you'll want to get rid of it, or are you guys just sort of going to wait and see what the market will bear before deciding when to exit that investment?
Yeah, great question. So the business plan for that asset is a 5-year hold. And so, when we run the spreadsheets before we buy, you've got to put in an end period to make the math work. And it could be 1 year, it could be 30 years, whatever. We chose 5 years in this case. It's not necessarily that the first 5 years are the best years, but and you're right, it will depend on what the market will bear. So let's assume, or not assume, let's say that when we get to the end of 5 years, that the market has crashed and the asset's not worth what we would want to sell it for. Well, then we may not sell it right then. The cash flow, we know that we bought it at a basis that's low enough that we can sustain either flat rents for 5 years if we had to, or maybe even rents coming down a little bit. So we think like cash flow wise, we're going to be okay. If the market's not right to sell it, then we just don't sell it quite yet. Or maybe it's a situation where the financing world is so favorable that we do some type of cash out refinance and keep it, but the cash that comes out goes to pay back investors, all or part of their investment. You keep your options open, so to speak. One interesting thing about Bryn Mawr, we're going to end up with what's called a HUD 223F loan. And that financing is a 35-year fixed interest rate and a 35-year amortization period. So it really juices the cash flow. And it's assumable. So it's 35-year fixed rate. So if somebody wants to buy it from us in 5 years, they still have 30 years left on a fixed interest rate. So that loan becomes an asset in and of itself, that there are groups in the world that will target and buy assets just because they have that loan. And Michael and I are we it's a lot of work to get that HUD loan, and we're right in the middle of it. So we spend a lot of time on these numbers and sending stuff back and forth to the underwriters, but we know it's going to be worth it in the end. It's a short-term little inconvenience for a 35-year benefit, or adding value to our asset.
Yeah, and the treasuries are starting to play ball, right? So if we look at the way things are trending and when we plan to rate lock this loan, it's probably going to land close to a full percentage point lower than what we've underwritten into those returns. So like the whole point about this conservative underwriting we harp on about is that the numbers that we're sharing with you should be the worst case scenario. That 22% average annual return should improve. Not only if you factor in that taxable depreciation, but also if we secure the loan at a full 100 basis points lower than what we underwrote, it's all net gravy to the limited partners. So that's the reason we approach it the way we do. But that loan is going to be a valuable asset.
Man, I hope that all comes true, Michael. Um,
It's trending that way.
it is definitely trending that way. Yes.
Who's the underwriter or bank that you use for those HUD loans? Just curious.
It's called New Point Financial is the one that we're using here.
And they were purchased by a group called Benefit Street Capital, and Benefit Street Capital is the current owner of the debt that we have on in place today. Did I say capital or partners? It's Benefit Street Partners.
Yeah. Yeah. Which, by the way, is owned by Franklin Templeton.
Yeah, it just keeps going up the chain.
Yeah, it keeps going up the chain. There's lots of people involved, but we're excited about that too on our personal resume. So we will have done then FHA, small balance loan. That's what we assumed on the purchase of the deal in Gastonia. We will have done balance sheet CMBS financing, which is what we currently have, and then we will have done a HUD loan. And these things are like notches in your belt, or they're resume items when you're in our business, because the next time now you're in the system, everybody knows you, and it's a real benefit. This first time is a challenge, just like anything you do for the first time. It's learning experience and the specific ways they do things. But we're very excited, and we're more than halfway through the process on that. And we think this is funny. The government, we say, well, when's your expected closing time? And they say, well, like October or December, that's somewhere in this 2 month window. But we'll get it done. It's been exciting. Let's see, on that one, by the way, we are, and this could all change depending on those interest rates, but we're looking to raise, like another $1.5 million for of limited partner investors. One thing that we think is important to note on that one, on the Bryn Mawr deal, is that it's not a pro forma. It's not something that we plan to go acquire. It's something that we already own, and a refinance is always more advantageous than a purchase loan. Plus, we've proven out our business plan. We've already put into place the reductions in the insurance and the payroll and the operational improvements and increase the vacancy or the occupancy and those types of things. So I think it's even less risky than investing in one that has yet to be purchased. It's pretty exciting.
How did you two meet?
Yeah, well, actually, so I'm a broker at Intracoastal Realty. My team, my real estate team, is under that umbrella. Fabulous company. I've been here almost 20 years, really. 15 years walking up and down the steps in this building. And I was in this office and I get a call from the broker in charge of our office, David Small, and he said, "Hey, I got somebody that you need to meet. This kid he's smart and he's wanting to go down the same path that you are." So we met and we hit it off. And right then and there. Oh, I did say, Michael said, "Well, I've got tattoos if that's going to be a problem." And I
I
remember
did
thinking,
say
well,
that. Yeah.
yeah, I said, well, like as long as they're not like on your neck or your
He goes,
forehead
"Are
or
they
something.
offensive?" I go,
Yeah,
"I don't think so."
yeah. So that clearly that was not a problem. But Michael's he is miles smarter than I am, and his ability to process data and numbers and work with the technology it blows my mind. I get like giddy about it when I say, man, I wish I could calculate this number. And before I finish the sentence, he's created this spreadsheet and filtered it and sorted it, and it's boom, it's right there. So it's
It's a
been a
great
great
balancing act,
relationship.
though. Ashley never gives himself enough credit, and I always have to do this. It's a great balancing act because the analytical power that's more on my side. He's the marketing and sales engine. So like there's pieces. There's a reason that the dynamic works so well. I
Yeah,
think.
I would agree. I would agree. Yeah, I
Michael,
was,
what made you move down south?
So at the time, I worked for a British-based company, and they basically, my boss was like, "Hey, you can live anywhere on the East Coast. So if you're me, 20, what was I, 27 years old, why are you going to be stuck in the middle of nowhere, Pennsylvania, when you could live at the beach?" So I made the decision. I did a road trip down the coast. I looked through Virginia Beach, Ocean City. I went to Charleston, Wilmington, and Savannah. And out of those choices, at the time, I landed on Wilmington, and it was a great decision.
Mhm.
Was the British company that you were with doing similar stuff? to what
No,
you guys are doing?
The British company is a manufacturing group. They own about 60 manufacturing groups around the world. And
Okay.
I have a previous experience of about 10 years in corporate purchasing. So I do a lot of work in supply chain as well.
Yeah, appreciate y'all taking the time out of your day to attend. And we're gonna have more of these. We enjoy doing these. We have to remind ourselves that, like, to us, this seems like second nature because we're in it so close all the time. But to other people who don't operate in this business, this some of this is interesting, and so we're happy to share it. If you guys have any specific topics you'd like to learn more about or have us do an episode on, let us know. We'll do it.
It's great. Thanks.
Yeah,
Yeah.
no, thank you. I'll just jump in here. Just thank you, Ashley, for the invite. I know we've
Yeah.
been some, but very nice to meet you, Michael, as well. And yeah, I'd love to stay connected and get to know you guys a little bit better and more what you're doing here with the multifamily side. So yeah, appreciate
Good
it.
deal. Yeah. Thanks for
Sounds
joining,
good.
Shane.
Thanks,
Very
Shane.
much.
Absolutely. Thank you guys for letting me join.
All right. You bet. Thank you all.
Thanks, everyone.
Thank you guys.
Yeah.
Thanks,
We'll
lads.
see you.
Guys.
Cheers.
Bye bye.